Thanks, Lawan. Good morning, everyone. It's great to be here this morning and great to see the growth of this conference. I remember attending some of the early marketplace lending conferences where almost everybody was wearing t-shirts and jeans. And looking out today, seeing mostly suits and ties, it's a reminder of how this industry has changed. This morning, I'd like to talk about just how much this industry has evolved in a very short period of time, and also highlight some of the key themes that I see going forward. I'll focus first on the peer-to-peer lending industry, which I'll define as marketplace lenders that originate consumer unsecured loans. I made my first personal investment in Lending Club in 2010, and about a year later formed Eaglewood Capital. Our first fund took over a year to get off the ground as we faced a number of obstacles, mostly from our key service providers, people like lawyers, accountants, custodians, and banks who are completely unfamiliar with the asset class. Today, we have the formation of an ecosystem that has developed to facilitate the flow of institutional capital into the space. And it now takes investors weeks, what used to take us months or even years to accomplish. 2010, loan selection was incredibly manual. Today, there are technology firms like Crowdnetic that can automate your purchasing and reporting at a fairly minimal cost. Lawan, where were you in 2011 when I needed you? I also remember vetting custodians, and they were uncomfortable with the fact that we were using electronic rather than paper loans. In fact, one custodian actually wanted us to print off our electronic loan portfolio and put it in a safe, which is problematic when you have thousands of loans in your portfolio. Today, there are technologies provided by firms like eOriginals that can provide electronic custody for loans. The auditors were initially uncomfortable with our ability to provide fair value of loans, and we spent 8 months going through the client acceptance process of a Big Four audit firm. Today, all of the Big Four firms have clients in the sector. 2010, there was no way to invest through a bankruptcy remote vehicle. Today, you can form your own, or you can go to one of the platforms and use their bankruptcy remote vehicle. Loans were sold entirely through fractional loans, fractional interest structures. Today we have whole loans. And in 2010, institutional purchase and service agreements were largely non-existent. In fact, I remember in one transaction negotiating 35 drafts of a purchase agreement over 5 months. That was a lot of fun. Today, Lending Club and Prosper have largely standardized those agreements. For leverage, we spoke to about 30 banks, and we received 2 term sheets and ultimately closed with 1 lender. Today, there are 10 banks providing leverage to the sector and many others in the pipeline that are trying to get in. 2010, regulatory awareness was largely limited to the SEC. Today, you have the CFPB, Treasury, FDIC, and a number of others who are getting educated on the sector. I'll let you decide if that's good or bad. So as this ecosystem began to form around P2P, the sector hit a tipping point in demand. And you saw an increase in volume of about 50 times to $7.5 billion from only $150 million in 2010. And there were a few key events that helped legitimize the sector and create this tipping point, which I've listed on this slide. The first was in late 2010 when Lending Club created the first bankruptcy remote trust, which is called the LC Trust. A few months later, Lending Club launched the first institutional fund in the space under the LC Advisors brand, and that vehicle has subsequently raised over $1 billion in capital. Eaglewood brought leverage to the market in 2012 and securitization to the market in 2013. And then in 2014, Eaglewood created the first publicly traded investment trust, which is listed on the London Stock Exchange. Later that year, we also saw the top 3 UK P2P platforms create whole loan programs, and Lending Club and On Deck both went public. Earlier this year, BlackRock completed the first rated P2P securitization. And I think this transaction was especially important as it was widely syndicated to a group of more than 30 institutional investors. And some of those investors included some trillion-dollar-plus AUM asset managers, some of whom were disappointed in their allocations. So needless to say, some of these investors are now going directly to the platforms to buy whole loans. So that's how we got to where we are today. I'd like to talk now about some of the more recent trends that I'm seeing. In 2014, the US P2P industry issued more whole loans than fractional loans for the first time in its history. Early on, retail investors dominated the investment on these platforms, and later on, you saw institutional investors like family offices, hedge funds, and fund of funds come into the sector. Over time, as the industry built track record and the ease of investment improved, an entirely new investor set came into the asset class, including insurance companies, banks, public funds, and pension funds. These investors generally have much lower return requirements. Borrowers have been the ultimate beneficiary of this transition, as Lending Club and Prosper have used the surplus of excess low-cost capital to lower their rates over the past 2 years. As I look forward, I think competition for borrowers among US P2P platforms is set to intensify. 3 years ago, I saw no viable competitor to Lending Club, but today when I survey the landscape, I see several well-managed, well-financed platforms in the consumer unsecured space, and many of these platforms are on track to originate north of $1 billion this year. If I had to take a guess as to the direction of interest rates in the P2P sector going forward, I would bet they're more likely to decline than to increase. And I think if you listen to Lending Club's most recent earnings conference calls, you'll find commentary that validates this view. So what's next? What does Marketplace Lending 2.0 look like? In a few years, I think we're going to look back and realize that the opportunity was far larger than the traditional P2P market that has dominated the headlines of the industry over the last few years. Within the US, I believe that we will see marketplace lenders achieve breakout scale in some very large lending sectors, such as non-qualified residential mortgages, commercial real estate mortgages, and auto loans. Today, marketplace lenders in these sectors are very much in their infancy, but the combined size of these markets is significant. It turns out that using technology to originate loans over the internet is a very efficient model that works almost everywhere in the world. And so, while the largest marketplace lenders today are primarily concentrated in the UK and in the US, I expect to see marketplace lenders achieve significant scale in other countries as well. Canada, Australia, and Brazil are a few of the countries where I think we could see very high growth because these countries have both high mobile banking usage and high credit card penetration rates. We've all heard the phrase barriers to entry. I like to talk about barriers to investment, the key obstacles that keep investors from investing in marketplace lending. I think the platforms have made a lot of progress in creating frictionless, seamless experiences for borrowers, but I think Marketplace 2.0 needs to do the same for investors. So let's talk through these barriers. Almost every institutional investor in the space is spending too much money on legal. Investors want marketplace lenders to create high-quality standards for their purchase and servicing agreements and then normalize those standards for everyone in order to lower transaction costs and increase transaction speed. I think Marketplace 2.0 will accomplish this. Operational barriers. I always say this is a back office intensive business investing in thousands of microloans. Investors want to receive accurate, timely reporting on time every month in a very seamless fashion. After loans are originated, they are sold, warehoused, securitized, and at every step in this process, there are multiple data points in the loan file that need to be verified, audited, and custodied. Some of these processes are automated in P2P today, but as we look out to version 2.0, I think we'll see greater automation in other sectors as well. I also believe the due diligence process needs to be standardized, and I envision a world in which investors can, in a very frictionless and seamless way, access a data room from the platforms, receive everything they could possibly want in that data room, and thereby eliminate the need for back and forth with the platform. On tax, offshore investors want to buy marketplace loans in the US, but marketplace lenders don't have large enough balance sheets to season them. Onshore investors are looking for ways to defer or reduce taxes on assets that otherwise produce ordinary income. I think we have solutions forming in the industry to these problems. Lastly, in order to attract liquid forms of capital, a secondary market needs to develop. I believe some of the necessary ingredients, such as a standardized legal framework and back office infrastructure, are already in place at some US platforms, but I expect a more robust secondary market to develop going forward. Pure marketplace lending platforms are completely reliant on third parties to fund their originations, which creates a lot of uncertainty for their business models. For this reason, we're already starting to see platforms move away from a first-come, first-served model and seeking out investors who have the ability to actually commit capital. Over the past 18 months, we've seen 4 asset managers list P2P investment funds on the London Stock Exchange, and these asset managers have collectively raised about $2 billion, with more in the pipeline. If you look in the US, we have 3 permanent capital vehicles, public funds, that have listed their intention to announce later this year. I think funds of this type will have a superior ability to commit capital to the platforms. I was interested to see that Funding Circle recently announced their intent to explore a publicly traded fund. If they are successful in getting that vehicle off the ground, I think we could see other marketplace lenders follow. As the platforms achieve scale, I believe they are going to focus less on driving more volume and more on fine-tuning their business models and their strategies. I expect to see a much broader product offering in the sector, and in the consumer unsecured space, I think this will take the form of both shorter and longer duration products. I also expect to see revolving and variable rate products develop. I also see products in the pipeline that have the potential to reduce payday lending and reduce interest rates for those borrowers. Credit models are evolving from algorithms to machine tool learning that uses real-time data to modify underwriting standards. Companies like Avant Credit are already incorporating this technology into their underwriting, and I expect more to follow. With more competition in the sector, securing long-term strategic sources of borrower supply is going to be critical to success. I also think we're going to see a much greater focus on monetization of turndowns going forward. And I know that later this morning, Crowdnetic will be discussing some possible solutions to this problem. In terms of funding, I've talked about committed capital, but I also think we could see a shift in focus back to retail investors in version 2.0. Retail investors bring diversification and stability to marketplace lenders, especially when institutional capital dries up, as happened in the last crisis. The problem has been that aggregating and providing customer service to retail investors is a very expensive process. But I think that the industry is currently developing tools and solutions to make this more cost effective. As I talk to large debt investors in the industry, I increasingly hear about their plans to take equity stakes in the platforms that they're committing debt capital to. I think this creates a much better alignment of interests between debt and equity investors than we've seen in the past, and also gives the debt investors the opportunity to participate in a lot of the upside that they're helping to create. I also would not be surprised to see asset management firms in the space simply create their own platforms going forward. Unfortunately, the sector hasn't made much money in the past few years, but it's interesting. As I've invested in different marketplace lenders around the world, I've noticed outside of the US a much greater focus on profitability, and I've even seen a few platforms that are net income positive. Going forward, I think you're going to see platforms put in place profit-sharing arrangements with clients, and also introduce ancillary fees such as charges for secondary market loan transfers. So recently I've been asked where I'm investing next in the sector, and I'd like to take a few minutes to talk about a couple of large themes that I see going forward. And the first theme is what I like to call picks and shovels, which is a reference to the California gold rush in the 1800s. During the gold rush, a few miners made a lot of money, but the key suppliers to the industry, those who sold equipment to the miners, made fortunes and did so with quite a bit less risk. We've seen a similar dynamic in the hedge fund industry over the past few decades. In the early 90s, there were only a handful of hedge funds in existence, but over time, an ecosystem formed around the industry and the asset class became mainstream. The estimated cost of starting a hedge fund came down quite a bit, and today sits at around $100,000. Today, there are over 11,000 hedge funds managing $2.5 trillion of assets. As the hedge fund industry grew, companies like Thomson Reuters and Market consistently made money serving the industry and did so with a lot less risk. Now, if you look at the cost of starting a marketplace lender, today it's around a few $100,000, which is actually down quite a bit from several $1 million just a few years ago. And so looking forward, I believe over the next decade we could see the formation of literally thousands of marketplace lenders. Regulation may slow down the trend a bit, but I don't think it will stop it. If you look in the UK, where marketplace lending is currently regulated, they've had over 100 platforms apply for P2P licenses this year. And so I see a very large opportunity for companies to establish themselves as a Thomson Reuters equivalent to the marketplace lending industry, serving as critical suppliers of data, analytics, and technology. Second theme is what I call convergence. Traditional lenders want what online lenders have, which is low-cost origination platforms. Online lenders want what traditional lenders have, which is cheap capital and access to large amounts of borrowers. Early on, the banks took a very conservative approach with this industry and primarily lent money to other investors who were buying whole loans. But more recently, the banks have actually started buying whole loans themselves, forming strategic alliances with marketplace lenders, and even looking to create their own marketplace lenders as in the case of Goldman Sachs. I think we'll see more marketplace lenders buying specialty finance companies because of the valuation arbitrage that exists between these two sectors. And I also expect to see a lot of specialty finance companies creating whole loan programs and turning themselves into marketplace lenders. So I think there's a lot more that's going to happen here, and it's only a matter of time before the difference between online and offline lending becomes indiscernible. And in fact, in the future, I don't even think we'll talk about online lending. We'll simply talk about lending. Since I left Eaglewood a few months ago, I've joined the advisory board of two companies, Crowdnetic and Harmony. I'm also an investor in both of these companies. I'm really excited about Crowdnetic because it touches on so many of the themes that I've discussed today, providing data, analytics, and technology to the industry, and helping investors break down barriers to investment. I also think Crowdnetic can play a role in reducing borrower acquisition costs. Harmony is the largest peer-to-peer lender in New Zealand and also just recently received regulatory approval to enter the Australian market, which I think has the potential to be one of the most profitable markets in the world. The PP sector has been a great place to invest over the past several years. But as the market has institutionalized, we've seen a major transition to low-cost capital sources. Looking forward to Marketplace Lending 2.0, I see a substantial increase in activity across multiple sectors and multiple geographies. I think there's a decade of opportunity here, and I continue to invest heavily into the sector. It's been great to be with you today. Thank you very much. Thank you.